This is class for Friday, September 4th, and apparently my live stream record did not take, so I'm going to run through what we did in class today. We started with this strategy for journalizing, and this is on page 5. And this is just going through the steps that will help you determine what you need to journalize and the accounts to use, that sort of thing. So the steps are: determine what accounts are affected and write them down. We've already been doing this, so this is just kind of a review. Reread the transaction and check yourself, and make sure you're looking for keywords. And keywords, remember, were listed at the end of your Chapter 1 worksheets. What type of accounts are you dealing with? Asset, liability, owner's equity, revenue, or drawing. Remember, that's going to go in line with the ALORE. Decide if you're increasing or decreasing the account, and then you'll apply the debit and credit rules from page 2 of this worksheet packet. So this is what I'm referring to when I say look back to your debit and credit rules, this exhibit right here. And I have been asked to bring a copy of just that for you guys to have as a reference sheet next week, so I will do that. Okay, so this box here, exhibit 4, this is just a chart of some very common transactions that you will see. And now the descriptions are generic. When you get into a problem, it's going to have a little bit more specific information, but generally this is what is happening, and you can see which accounts you need to debit and which accounts you need to credit. So it's just kind of a helpful hints sort of thing. All right, so let's look at how we would journalize an asset purchase. So in this case, we are told to prepare a journal entry for the purchase of a truck on June 18th for $35,000 cash. So what are we purchasing? We're purchasing a truck. We're using cash. So the two accounts we will use in this problem are truck and cash. Now, what kind of account is truck? It is something of value. It's going to last more than 1 year. It's not an expense for that reason, so it's an asset. We know cash is an asset. So is the truck increasing or decreasing? It would be increasing, and cash would be decreasing. Well, look back at your chart on page 2. How do we increase assets? We increase assets with a debit, and we decrease assets with a credit. So there you have your journal entry. You'll put the date in, and you will debit truck for $35,000. Now, you're not going to use decimal places on our journal entries, and you only have to write the month on the first line of each entry and the date as well. So we'll just put the date on that first line. We put the first account that we're going to debit all the way to the left. All your debit accounts will appear all the way to the left. And then we'll kind of indent for our credit accounts. So we're just going to credit cash $35,000. The next entry we're looking at is a journal entry for fees earned. So we are to prepare a journal entry on September 22nd for fees earned on account. So fees earned is one of our accounts. On account tells us that it's either receivables or payables. Well, because we are earning fees, it will be accounts receivable. So is our fees earned account increasing or decreasing? It's increasing. Accounts receivable is also increasing. And the step where we determine what type of account it is out of ALOR or E, fees earned is a revenue account. Accounts receivable is an asset account. So how do we increase revenue accounts? Do we increase them with a debit or with a credit? Look back at page 2, and you'll see that we increase revenue accounts with a credit. And you remember we increase asset accounts with a debit. So you will put your date 22nd. And debit account first, which is accounts receivable. We'll debit for $85,000 and we'll credit fees earned. $85,000. One thing I did forget on here, just to get you familiar with what descriptions to write, right under this we could write fees earned on account. For the most part, we won't use descriptions because it just takes extra time and it takes up room. On this previous one, we would say purchased truck with cash, for cash. You could even say 2015 Ford F-150. Just depends on the circumstances, you know, that you're going to be more specific based on what's happening in the particular business. We won't be writing descriptions in a lot of our work simply because it just takes time. They are important in a business, but for our exercises, we will omit them quite a good bit of the time. So you will see in your instructions in Cengage that it will often say omit descriptions, and that's what it means. Okay, so this last one, we're going to prepare a journal entry on December 30th for the payment of $8,500. So we've got a payment of $8,500 to the owner of Speedy Car Wash, and his name is Jacob Wilson. It's for personal use. So if we have a payment of $8,500, we know that cash is part of the entry. And we've got the owner getting paid for personal withdrawal. So we'll say owner withdrawal or owner drawing. Okay, so cash is an asset. Cash is decreasing, so it is a credit. Owner drawing is your withdrawal account. And it is increasing, so we will debit that account. And also, as you're doing these, and you know, maybe you know that cash is going to be a credit on this one, but you're not sure what to do with the other side. It's got to be a debit to make your entry balance. So you know whatever it is you choose will have to be a debit, and then you'll just have to determine which account it is. And whenever you have an owner getting money out for personal use, it's always going to be a draw or drawing. So we'll put the date on here. You can abbreviate December. We'll debit Jacob Wilson drawing, and we'll credit cash for $8,500. Okay, and we can say owner withdrawal for our explanation. Okay, the next thing we're going to do is take these very same November transactions for Net Solutions that we've been looking at since day one, and we are going to go through that four-part process of determining which account these are going to go to and what type of account: increase, decrease, debit, credit. And then we'll journalize them. So the first thing that happened was that Chris Clark opened a business bank account using his personal funds. So if you remember, obviously this part is going to be cash, but he's using personal funds. So when they do that, that is going to go to his capital account. So I'm going to abbreviate his name and just put capital for now. And the cash for the business is increasing because the balance in the beginning is zero, and then he's putting $25,000 in, so the cash balance is going up. That will also increase his capital as an investment. Well, cash is an asset account. I'll just put an A here. Remember, we're using asset, liability, owner's equity, revenue, expense. And then capital is your owner's equity account. Okay, so how do we increase an asset? Look back at page 2. You'll see that we debit an asset to increase it. And to increase a capital account, we will credit capital. Oops, I should say credit. Credit, capital. All right, so on the 5th, paid $20,000 for what? First of all, we got paid, so that's something to pay attention to. For the purchase of land as a future building site. So paid is telling us that cash is being used. So what did we pay for? What did we get for our money? We got land. So what kind of account is cash? Asset. Land is also an asset. Land is something that we'll have for a long time. It's valuable. It's not something we're going to write off as an expense. So it's an asset. Are we increasing cash or decreasing cash? We're paying, so our cash is going down, but we're getting land, so it's increasing. And to increase an asset, you debit. To decrease an asset, you credit. And that's found on page 2 again. Okay, purchase supplies for $13.50 and agreed to pay later. So we purchased supplies, agreed to pay later. So we got supplies and we're going to pay later. So if we are paying later, it's not going to be cash that's affected here. It's going to be accounts payable. Supplies, what kind of account is that? It's an asset and it's increasing. So we will debit supplies. Accounts payable is a liability. We are also increasing it, but to increase a liability, you will credit that liability. The next one says received cash, so we know cash is going to be a factor. For what? Providing services to customers. It's not accounts receivable because there's no on account mentioned, and there's no customers will pay later or bill or any of that sort of language in here. So we know that it's going to be fees earned. Okay, so cash is an asset. We're increasing it. We've got a debit. Fees earned is revenue. We're increasing it. Will be a credit. And I hope this is not just so small you can't read it. All right, so for the next one, paid the following expenses. So we've got the word paid as our keyword. That tells us that cash is involved. And then we've got expenses. Well, I'm just going to write expenses here because I don't want to write every one of them. We're going to have to list them out separately in the entry. But just for the sake of going through these steps, I'm going to just say expenses. So cash is an asset. Cash is decreasing, so we'll credit cash. Our expenses are expense accounts, or E. They are increasing. We increase expense accounts using debits. All right, the next one, paid creditors on account. So that means the Net Solutions paid, so that tells us cash. What did they pay? Creditors on account. Well, creditors are people that they owe, and they're paying on account. So that would be accounts payable. So our cash is decreasing because we are paying money out. Cash is an asset, so we will credit cash. Accounts payable is a liability. It is also decreasing, and we decrease liabilities by using a debit. All right, the last two. Chris determined that cost of supplies on hand was $5.50. Well, if you'll remember, up here at the top, he bought $13.50 in supplies. Well, on hand means what he's got left. So we need to determine how much was used. And that comes to $800. Okay, so for future reference. So we know we've got supplies that we're going to have to change. And when we use supplies, they become supplies expense. So we're going to have supplies that we use. We'll be using supplies expense. So our supplies, that's an asset account. And it's going to decrease. So how do we decrease an asset account? If in doubt, look at page 2. All right, supplies expense. Well, it's an expense, and it's increasing. To increase an expense, we'll use a debit. The last one on here, Chris Clark withdrew $2,000 from Net Solutions for personal use. Well, we know we've got cash involved because he withdrew cash. This is the owner, and he's withdrawing money for personal use. So we know we've got cash. And the other account is going to be drawing. So we'll just say Chris Clark drawing. All right, cash is an asset. It's decreasing because we're paying him money. And so we'll decrease it with a credit. Drawing is a withdrawal account. We're increasing it. You increase drawing with a debit. So the next thing we're going to do is skip down to page 8. That's the first page of our journal pages. And we're going to journalize these entries that we just worked on. So on the first line of every journal page, you'll write the year, the month that you're recording entries for, and you'll put the day in the smaller blank. So in the first entry, we said that he had put cash in, and that was a capital contribution. So we're going to debit cash for $25,000. Remember not to put change on there. And this column here, don't worry about for now. And then we're going to credit Chris Clark Capital for the same amount. Okay, second entry, you can skip a line in between if you want. You don't have to. If you're worried about having enough room, just move down to the next line. We're not going to use descriptions or rather explanations just for the sake of time. So in the next blank, we will put just the day number. We don't have to write the month for every entry, and you only write the date by the first line of each entry. So in this entry, we are debiting land because we purchased land, and we're crediting cash because the land was purchased using cash. Okay, on the 10th, we have supplies purchased with an agreement to pay later. So we're debiting supplies, crediting accounts payable for $13.50. All right, for the next entry on the 18th, we are receiving cash for providing services to customers. So we're going to debit our cash and credit our fees earned. And all of this is coming from those November entries, 2 pages up, where we went through the 4 steps and assigned the information to them to determine how we're going to record these. Okay, on the 30th, paid the following expenses. All right, so we're going to debit each expense. We've got wages expense. We've got rent expense. We've got utilities expense. And we've got miscellaneous expense. And here, I don't mind if you abbreviate miscellaneous. It's a long word. Okay, so wages are $21.25. Rent expenses $800. Utilities are $450. Miscellaneous $275. I had one student ask, do we have to list these in the same greatest to least order that we do on the income statement? The answer is no. They happen to give us these numbers in that order, so it just happened to work out that way, but you are not required on a journal entry to put the greatest numbers first. Okay, so we're going to credit cash to show that these were paid. So we'll add all of these numbers up, $21.25 plus $800 plus $450 plus $275, and we have a credit to cash for $36.50. So you can see in every entry we have an offsetting credit to our debit that makes the entry balance. So in this case, this would have to total $36.50 or the entry wouldn't balance. So we're going to credit cash for the amount of each expense added together and show that cash was reduced by that amount. All right, the next entry on the 30th is paid creditors on account $950. We said that was a debit to accounts payable of $950, and a credit to cash for $950. All right, and then the next entry on the 30th is moving these supplies to supplies expense to show that they have been used. So we will debit supplies expense for $800, and we will credit our asset account of supplies by the same amount. Now our supplies on hand and the number in our asset account called supplies is the same amount. Okay, so the last entry on the 30th is to record Chris Clark's draw. So we will debit Chris Clark drawing, and we will credit cash for $2,000. All right, if you're puzzled about the $800 on supplies and supplies expense, remember that I showed you up here that we bought $1,350. We know there's $550 left, so we used $800. So that is where the supplies expense figure came from. Okay, so that's all for Net Solutions November entries. The next thing I asked class to do was to go back to your December transactions and go through those 4 steps, work through these on your own, and go through the steps to prepare these for making your journal entries for December. I went through the first 3 with them because they're a little bit different. The first one says Net Solutions paid a premium of $2,400 for an insurance policy that covers 1 year. And since it covers more than 1 year, rather, we're going to classify that as a prepaid expense called prepaid insurance. So prepaid insurance is a more specific name for a prepaid expense account. It's prepaid because this policy covers an entire year, and we're purchasing it on December 1. So the policy is going to cover Net Solutions from December 1st of this year to November 30th of next year. So we're not going to show expense in the whole at one time. We'll show 1 month worth of expense at the end of every month, and we will do that entry in the next part that we get to. I believe it's in the next chapter where we do adjusting entries. So for now, we're just going to put it in an asset account called prepaid insurance. All right, asset account. And so we are increasing our prepaid insurance, what would be a debit. And then we are paying for this prepaid insurance. So it says paid. So we know we're going to have cash. Cash is an asset. Cash is going down because we're paying for something. So that will be shown as a credit. This next entry, I just put some comments in here because Net Solutions had just paid rent for November, like at the end of November. And I put this in here because apparently their landlord went from pay at the end of the month to pay at the first of the month. So they're going to have 2 rent payments that are really close together. So really, you'll just record it the same way. It's just in case you're wondering why they had a rent payment at the end of November and then another right at the 1st of December, why that happened. So on this next entry, we have a situation where a local store wants to rent that land that Net Solutions purchased in November, that $20,000 of land. They're not using it right now, and this store wants to use it as a parking lot. So Net Solutions agrees that they'll rent it to them for 3 months. They're going to give it a shot and try it out, but they want all the money up front. So because it's December 1st and this rent will be for 3 months, so as of December 1st, no time has passed, so they really haven't earned that money yet. So this amount of money that they are collecting, because it's for future rent, they're going to put it in an account called unearned rent. Unearned rent is an unearned revenue account, kind of like we had prepaid expenses, we have unearned revenue, but we're specifically calling these accounts, a different name. So unearned rent is what we will call this because it's a liability. Until they earn it, it is a liability. So apparently we will have unearned rent as one of our accounts. And because they are receiving money, they received this money, then we've got cash. So unearned rent, I'm telling you, is a liability account. Because if for some reason, depending on their contract, but anytime you collect money ahead of time, ahead of doing a job, it's a liability until you fulfill your duties as the one collecting the revenue. So that makes it a liability. So cash is an asset. We know that our cash is increasing, so that one's going to be easy to figure out. Well, this unearned rent account didn't exist before this transaction, so it's increasing. And liabilities, to increase them, we credit. Well, if we didn't know that for sure, we know that we've received cash and that we have to debit. So we know we're going to have to credit something. And we're told in the problem that we're going to credit unearned rent. And we will do the same thing that we did with insurance. At the end of the month, we'll make a journal entry to show that 1 month's worth of this rent has been earned. Okay, so what I want you guys to do is to go through these entries and just go through these steps like we did on all the rest of them. And we will pick up on Wednesday with these entries, since Monday is a holiday. And enjoy your time off. And if you have any questions, let me know. But I will be posting some homework along with your assignment quiz. Attendance quiz assignment is what I mean. So you'll have the attendance assignment as well as some homework to complete. Have a good weekend.